Imagine waking up one morning and checking your bank account only to find that everything you worked for is gone. Not stolen, not lost, just evaporated. Vanished without a trace, as though it had never existed at all. That's exactly what happened to millions of Americans in October 1929. In a matter of days, the United States lost more wealth than it had spent fighting the entire First World War. Think about that for a second. Years of labor, savings, dreams, gone faster than they could be counted. This is the story of how greed, delusion, and a whole lot of borrowed money brought the most powerful economy on earth to its knees. To understand the crash, you have to understand the party. The 1920s in America were electric. They didn't call it the Roaring Twenties for nothing. World War I was over. The boys were home. The economy was booming. New technologies, radios, automobiles, refrigerators, were flying off shelves faster than factories could make them. Cities were growing. Jazz was playing. Optimism was in the air like a drug. For the first time in history, ordinary Americans felt like they could get rich. Not just the bankers, not just the industrialists, the clerk, the factory worker, the housewife. And Wall Street was their ticket. Before the 1920s, the stock market was mostly a playground for wealthy insiders. But something shifted. Something fundamental changed about who was allowed to play, and more importantly, how they were allowed to play. Banks started offering something called buying on margin, meaning you could buy $100 worth of stock by putting down just $10 of your own money. The bank covered the rest. You were essentially borrowing 90% of your investment. It sounded genius, and for a while it was. Stocks went up, then up some more. Between 1920 and 1929, the Dow Jones Industrial Average, the key measure of the stock market, rose nearly 500%. 500%. That's not growth, that's a rocket ship. Taxi drivers were picking stocks. Housewives were investing their grocery money. Shoeshine boys were giving tips on shares. Barbers, teachers, factory workers, everyone was in. Everyone was winning. The market felt less like a financial instrument and more like a magic money machine. And nobody stopped to ask what would happen if the music stopped. But behind the glittering headlines, the cracks were already forming. Silent, invisible, and spreading. By mid-1929, the real economy was quietly cooling off. Factory output was slowing. Farmers, who had never really shared in the prosperity of the decade, had been struggling for years. Consumer debt was piling up as people spent money they hadn't yet earned. The gap between the rich and everyone else was enormous. But the stock market just kept climbing, completely disconnected from reality. Economists call this a speculative bubble. Prices rise not because companies are actually worth more, not because profits are higher or products are better, but simply because people believe prices will keep rising. It's a game of confidence, a collective hallucination. And confidence, as history teaches us over and over again, is fragile. Then came September 1929. The market started wobbling. Small tremors. A bad day here, a nervous week there. People told themselves it was a correction. Healthy, even. The fundamentals were strong, they said. They were wrong. On October 24th, a day that would become known as Black Thursday, panic hit. Not worry, panic. Investors rushed to sell their shares all at once. Prices began to nosedive. The ticker tape machines that reported prices couldn't even keep up with how fast things were falling. The numbers on the board were already outdated by the time people read them. Bankers tried to intervene. A group of the most powerful financiers in New York pooled their money and started buying stocks to calm the market. It worked, temporarily. The weekend came. People caught their breath, talked each other down from the ledge. Maybe it was just a blip, they thought. A panic that had run its course. It wasn't. Monday brought more selling. Heavier this time. More desperate. Then Tuesday arrived. October 29th, 1929. Black Tuesday. It was the single worst day in the history of the American stock market, and nearly a century later, it still holds that reputation. Over 16 million shares were traded in a single day, a record that would stand for decades. The floor of the New York Stock Exchange was chaos. Men in suits screaming, waving paper, trying to unload investments that were losing value by the minute. Prices collapsed. Companies that had been worth billions on Monday were worth almost nothing by Tuesday afternoon. People who had borrowed money to buy stocks, remember that 10% margin deal, now owed far more than their shares were worth. Brokers called in the loans immediately. When people couldn't pay, banks seized their assets, their homes, their savings, their furniture, everything. And then the banks started failing too. Because here's what most people don't fully appreciate. When the banks lent money to all those margin investors, they used depositors' money to do it. Ordinary people's savings. So when those loans went bad, the banks didn't just lose their profits, they lost their customers' money too. Within 3 years, nearly 11,000 American banks collapsed. People's life savings disappeared overnight. Because back then, there was no government insurance on bank deposits. If your bank went under, your money went with it. Full stop. No recourse. No safety net. Nothing. The human toll was staggering. Unemployment skyrocketed from 3% to 25%. 1 in 4 Americans was out of work. Not laid off temporarily. Out of work, with no clear path back. Soup kitchens stretched for blocks. Families lined up for hours just to eat. Tent cities called Hoovervilles, a bitter nod to President Herbert Hoover, who many blamed for failing to act, sprang up across the country. In the richest nation on earth, people were living in cardboard shelters. The Great Depression had begun, and it would last for more than a decade. So what do we actually learn from 1929? Because if we don't learn from it, we're just watching history for entertainment. Lesson 1. Leverage is a double-edged sword. Buying on margin amplified gains on the way up, but it destroyed people on the way down. Borrowing to invest means that when things go wrong, they don't just go wrong. They go catastrophically wrong. The same math that made you rich in a bull market wipes you out completely when the tide turns. Lesson 2. When everyone agrees the market only goes up, that's exactly when to worry. The loudest signal of a bubble isn't the price charts. It's the culture around it. When ordinary people with no financial training start acting like geniuses because everything they touch turns to gold, that's not skill. That's momentum. And momentum, by its very nature, reverses. Lesson 3. Confidence is the real currency. Economies don't just run on money. They run on trust. Trust that your bank will be there tomorrow. Trust that the check will clear. Trust that the deal you made today will still mean something next week. The moment people stop trusting banks, stop trusting the market, stop trusting each other, the whole system seizes up. That's a lesson that rings true in every financial crisis from 1929 to 2008 to whatever comes next. Lesson 4. Regulation exists for a reason. In the aftermath of the crash, the U.S. government passed sweeping reforms, the Glass-Steagall Act, the creation of the SEC, Federal Deposit Insurance. These weren't anti-business moves. They weren't socialism. They were the floor that prevented the entire house from caving in again. The rules aren't there to slow the market down. They're there to make sure the market survives long enough to be worth playing. The 1929 crash didn't just wipe out fortunes. It reshaped the entire relationship between government, money, and the everyday person. It gave birth to social safety nets. It changed how banks operate, how markets are monitored, how risk is managed. It forced the world to ask a question it had never seriously asked before. Who is the economy actually for? Almost 100 years later, that question is still being debated. Loudly. In Congress, in boardrooms, on the internet at 2 in the morning. The names change. The technologies change. The financial instruments get more complex. The numbers get more zeros. But the human instincts, greed, fear, the desperate, stubborn hope that this time is different, never do. History doesn't repeat itself exactly, but as Mark Twain may have said, it sure does rhyme. If this video made you think twice about how markets really work, smash that like button and subscribe. Next week, we're going somewhere even darker in the history of money. You don't want to miss it.